Welcome, everyone, to Getting Your Edge, How to Downsize Your Home podcast. I'm Dennis Day with the Edge Group team and EFP Realty, and I've got my co-host, Judy Grattan.
Hello.
The managing broker of our Edge Group team. And today's guest is Admiral Flender of Fairway Home Mortgages. And he's going to talk about a product that I think you'll find incredible that can really change your life. Before we get started, I'd like to ask you to like this podcast, subscribe to the podcast, share it with someone so we can build an audience that gets this information that can be so valuable to people. All right, let's get going. We're going to talk about something that has a bad rap, reverse mortgage. Explain, Judy, what?
Well, I just know that for a long time, when I've talked to people and mentioned reverse mortgages, they have like, no, I don't want to get involved in that thing. I've heard horror stories about it. And we were talking with Admiral about the home equity conversion mortgage, which is the name for Fairway's home equity conversions. And that's really what a reverse mortgage is. It's getting access to the money in your home. And I'm going to let Admiral explain a little bit about what was the problem, or what did people conceive to be a problem with that mortgage in the past, what really was happening, and what's happening today.
Well, Judy, and Dennis, so we call it the home equity conversion mortgage, but it's always going to probably be known as a reverse mortgage. But it's called the home equity conversion mortgage because it's a specific type of reverse mortgage insured by the U.S. federal government that allows homeowners 62 plus to access a portion of the equity,
Right.
or we could call it their housing. And part of the reason that it got a bad name, so we like to call it, the product that we have today is a distant cousin to the product that was in the past. There were some safeguards that have been built into the product that make it safer. In fact, it's the safest mortgage available because there's this very strict requirements in order to protect the senior class, which is a protected class. So back in 2015, significant safeguards were built into it, but it back up just a little bit. And most of us can remember back in 2000s that there were a lot of so-called bad mortgages.
Yes.
And this was a highly unregulated industry. For example, realtors did not have to have a license, nor did loan officers. And there weren't background checks, and there weren't credit checks, and there were all these things that the bad actors were. If you could breathe a mirror, you could get a license.
I joked with people, you could put a Band-Aid that said for sale on the front door of your house and get it sold, because that was another one of those periods of time where we had not many homes available, and they were appreciating like mad. Whenever there's a shortage of something, they're always going to go up, and that you could get a loan, just the stated income. I make $1 million. Okay, you get a loan without ever having to substantiate that you actually made $1 million. So it was a very crazy period of time, and it crashed badly in, I think, around 2005 or 6 is when it started. And I will never forget walking into a home where a family had lost their home in foreclosure, and their teenage child had written from floor to ceiling on every wall in their bedroom what happened to their family. And I was crying when I walked out the door. That was crazy. They were stealing copper out of homes. People were squatting in vacant homes. It was crazy and dangerous. And I'm glad that period is over. I hope we never go through it again. But somehow the reverse mortgages got caught up in that as well. But they actually started, did you say, in 1989, I believe. I remember seeing some famous actors on I can't think of his
Tom Selleck.
Tom Selleck,
Yeah.
standing there in his very calm and deep voice talking about reverse mortgages. And I remember people being that they wouldn't have anything left to leave their children. A lot of people to this day don't understand equity and how your home, you buy a home for a certain amount of money, and normally homes go up in value every year, no matter what, just because of inflation, I guess. But when demand comes in, when there is a shortage of homes, it causes equity to grow insanely. I mean, 25, 50%, depending on where you are and what your market is. And we've seen a lot of that here in the Northwest over the last, I would say, 10 years, because we've had such a shortage of inventory. And so that money, when you bought your home for 130,000 30 years ago, we're talking here basically because reverse mortgages are for seniors. You can't really qualify for one unless you're how old?
62 or older.
62 or older. But if you've been in your home for 25 or 30 years and you paid 130,000 for it back in the late 1900s or whatever, now worth $1 million. So that money, when you go to sell, there's your equity right there. And so a lot of people think, well, I have to sell my home to get to that money. And I can't do the things I want to do in retirement until I get to that. But then there are also people that think, well, that's my wealth that I'm going to leave to my family. And in this day and age, most people are not really looking at that as much as they used to. At least I'm not. So anyway, I think am I on the right track there?
Absolutely.
With
Absolutely.
the home equity conversion. So what you're doing with this home equity conversion mortgage or a reverse mortgage is being able to get access to that money that has been building in your home all these years before you sell it. And there's some real benefits to the whole thing, right?
Absolutely. So the Consumer Financial Protection Bureau regulated all mortgages. And so, as I'll continue to say, don't like to refer to it as a product, but it is a product and it is a distant cousin. This product that created such bad press, what we have today is a distant cousin to that particular product. And there's some things that we didn't do. We didn't realize that we had to make sure that that our clients were used to paying their property taxes on time, paying their insurance on time. And now that's part of the regulations. And because it's designed to be a sustainable resource, even if we have a situation where a client has not, for whatever reason, paid their property taxes and insurance, we can then take a portion of that equity and put it in layman's terms, we would call it in a escrow fund, so that then those payments are made on time. And we actually take the number way at 20% because things do go up. But then it that's one of the safeguards built into it to make it a sustainable solution.
Because when people weren't paying their property taxes, and particularly, and we all know there's only two things that you have to do. One is die, and the other one is pay taxes. The government will foreclose on your home. So even though you're fine with the lender, you're not fine with the government. And so if those property taxes aren't paid, they will foreclose and you'll lose your home. And then with it goes the equity that you were accessing.
Are you tired of the big house and the endless yard work? Are you ready for the next step forward in your life? Meet the Edge Group team, the downsizing experts in the Seattle area. With eXp Realty, we bring the experience, vetted vendors, and passion you need to transition to a simpler, less expensive lifestyle. Imagine freeing up your time to focus on what you truly love doing instead of chores you have to do. Our dynamic team offers over 30 years of expertise in the Puget Sound region. Less house, more home. Discover the art of downsizing with us. Reach out today and take the first step towards your new exciting lifestyle.
Correct?
Yes. And that is whether it be a reverse mortgage or a conventional mortgage, you don't pay your property taxes and insurance,
Yes.
you will be foreclosed on.
Because the lender requires, and with good reason, that you have insurance. So if the home burns down or something like that, their investment is covered. Right?
Exactly.
Yeah.
Exactly. And with all due respect to the actors, by the way, President Reagan, one of the great things that he did was create this program. It was really designed so us seniors would have a higher level of dignity as we mature. And it is really designed to give us a better life. I can't legally call it a program that it's like Social Security. It is like Social Security in that you have to reach the age of 62 in order to be qualified to do it.
Now, I had also heard that, and you, that that they were issuing this mortgage based on the age of the oldest person in the house versus the youngest person in the house. And so people were afraid that they were going to be thrown out. Like if the husband or wife were older, the other party who was younger, when that person died, that the mortgage had to be called in, the house had to be sold, and that person was left homeless, basically. And that is not the case.
That
Correct?
is not the case. It's actually based on the youngest person's age. So because that younger person, they're theoretically they're going to live longer, and so
Correct.
there's something called a maturity event. And the
Mhm.
maturity event is if you sell the home, it's that then the balance must be paid, or if you leave the home, or if if both people pass away. But one of the things that gave us a bad name is that we weren't double checking to see if the younger spouse, if they were on the mortgage.
Yes.
And so the fact that you can get a larger access to more equity, the older you are, that younger spouse was not put on the mortgage.
So here's a question for you, because we keep using the word spouse. What if you have two single individuals? Can two single individuals do a reverse mortgage on a home that they own? Because you can buy as two single individuals in joint tenancy. So can you get a reverse mortgage as two single individuals living in the home?
Yes.
Okay.
Yes, living in the home. And so what was happening in the AARP actually sued, put out a suit because older guys were dying and their wives, their name was nowhere to be seen. So
That's where they were having to move out. The home was kind of a forced sale.
so now there's no way. It's always going to be based on the youngest person's age. And now a spouse can pass away, and then you can remarry those, but that new spouse will not have the same access to like the line of credit or any of those things unless they then would have to refinance and do additional.
Can you refinance a reverse mortgage? And you take one and then do another one and cancel out the first one?
If you have enough equity.
Okay.
And with this growth in the appreciation in homes, there was a lot of refinancing done. And so it's like any other mortgage, but the difference is that you have to have a certain percentage of equity in order to be able to originate this type of mortgage.
So can you explain what that looks like? You make an application for the loan. Is it based, because we're talking about people 62 or older, hopefully maybe they're in retirement, maybe they're not. Do you look at what they have beyond the equity in their home, like stocks, retirement funds, work, if they're still working? Is all that taken into consideration, or are you looking strictly at the house, the equity in the home?
The equity in the home is certainly the major factor, but the credit terms are considerably less stringent than a regular mortgage. In other words, a person could have a low credit score, but if they paid the mortgage on time, and if they paid their insurance on time, we have a 2-year look back. If those have been paid, then it makes it, and then we want to also make sure that there is enough reserve, because the last thing we want to do is refinance a house for individuals who don't have enough reserves to keep the home up. Those things are factored in. That's what we call our financial assessment. But for a single individual, after all their bills are paid, if they have $589 left over, they're going to qualify for the mortgage.
Now, here's a question that just came to mind. So they've made their house payment. They keep making their house payment. Over here, however, they have multiple credit cards and medical bills and things that are in arrears, to the point where maybe they have to declare bankruptcy. If there's too much equity in a home, I think that home must be sold to give money back to these creditors. Do you look at that? Do you consider that? I mean, when you said a low credit score, what are you referring to?
Something under 600.
Okay. All right.
And as long as, regardless of what their outstanding balances are, If
Okay.
there are enough reserves
Okay.
where they can continue to make those payments on time, we really don't care. The thing we really focus on is, do they pay their property taxes on time? They pay their insurance on time.
And
And
they
if they
maintain
still have mortgage payments, that they've made those mortgage payments on time.
and can maintain the home. And a lot of people that we run into in trying to that are looking to downsize and sell their homes, a lot of times it's because they're getting to a point, middle class America, let's face it, they don't have the money to maintain those homes. And it's heartbreaking to walk into a house where the roof should have been replaced 10 years ago and they haven't had the opportunity to paint it. And so there's dry rot or whatever. And yet you see it. I mean, you drive around and you see it where they just have not taken care of the home. This sort of thing, if you were able to get it before you got in that position and you stayed in the home, you would not be making mortgage payments where you could maybe afford to pay the house or get the roof or do the things that really need to be done to maintain your investment, your home.
Let's talk about what are the HECM is essentially a distant cousin of the home reverse mortgage from the past. So what are the advantages for the homeowner who has paid off the home or has a small mortgage at a low payment and a lot of equity? What advantages does this loan?
So part of the equity in the home is set up in a fund that's called a line of credit. And that's actually, in my opinion, that is the number one advantage to doing this. So that line of credit, it's hard to wrap your mind around it, but that line of credit actually has a growth feature. Will actually, if you just leave it there, it will just continually grow. We've seen instances where individuals, they didn't need the money. They just set it up in the event that they had a long-term care event or situations that occurred in the past, that the actual line of credit this is like over a 20-year period, actually exceeded the value of the home.
That's not true with most lines of credit. This is the reverse line of credit.
Yeah. In fact, some people, they look at it and they think it's too good to be true, because how can that be?
And is that tied to the appreciation of the home?
It has nothing to do with the appreciation of the home. And that's one of the things that seems too good to be true. Regardless of what's happening on the value of that home, that line of credit will continue to grow. It's tied to a treasury note, but right now the appreciation rate is 6.85. I did one yesterday, and so that is compounding monthly. So I had an example for a client yesterday. Their home was worth 1.150. They owed $355,000, but we were still able to set up a line of credit of about $60,000. And I think we looked over a 5-year period, that $60,000 had grown to $120,000. And it will continue to grow regardless of what's happening with the value.
So when you say you set this up, this is not a standard HELOC, as they're referred to, home equity line of credit. This is the reverse mortgage. So this $60,000 is sitting there, but they're not making loan payments at all. Not on the mortgage, not on the HELOC.
Yes, there's no requirement on that. But what's really interesting, and this is another thing that seems too good to be true, I have clients who continue to make that mortgage payment. And that amount, so let's say if it's $2,500, they make that payment, 5 business days later, they can go right in and take that $2,500. Question to ask, it's their money, they're just borrowing their own funds. So there's that, and so we're looking at that 6.85 compounded monthly. Many of our clients will spend their emergency fund because their line of credit then becomes their emergency fund.
So with this home equity conversion mortgage, you don't have to make a monthly mortgage payment, correct?
That is correct. But each time we say that, we have to say, but property taxes and insurance must be paid.
Okay. But they can make a payment like they had been doing before the home equity loan conversion mortgage. And that builds up the line of credit. And it is like an investment, which you were saying was a 6+ return.
Yes.
Okay.
What is in general, what is the interest? I know it would probably vary on, each person based on, like you said, their credit. But what is the interest rate on, because it is a mortgage, there is an interest rate, and it is put against the balance owing, correct?
Yes.
All right.
And that interest rate it varies. And so it is a variable rate.
It's always a variable
It's
rate?
always a variable rate.
Okay.
We have a fixed rate, but the fixed rate really 95% of our clients are going to use a variable rate because when rates go up, their line of credit is growing. We have some clients that they celebrate when the interest rates go up because they know that their return on that line of credit is going to be much higher.
Okay. So the way I think I'm envisioning this, you look at the home, you have it appraised, you determine the value of the home, you're willing to basically lend, quote unquote, the full amount of the value of the home, or 80%, or what percentage of the appraised value is a lender willing to do a reverse mortgage on?
Well, we don't. So let's say, for example, a client had a home that's worth $1 million.
Mm-hmm.
And I'm looking at my phone because I can do a quick calculation. The home is worth $1 million. And let's use the youngest age, which is 62. That individual would have access to $1 of the line of credit.
Line of credit.
And what could they spend that on?
Anything. It's their money. It's their equity.
How quickly can they access that?
5 business days.
5 business days. So if they want to go on vacation, they can pull from that fund if they want to.
Absolutely.
And that fund will continue to grow at the interest rate, the current interest rate tied to a treasury note.
Yes. And today that's 6.705%.
And this can get so complicated. Everybody's going to go, and their head will explode. But treasury notes go up when the stock market is going down. Is that correct? And then vice versa. A little bit?
I wish I could answer
Okay.
that. That's not my area of expertise. One of the things I also need to mention is that when I talk about safeguards that were built into this program. So one of the challenges that we had in the beginning is that, let's say, for example, the same client had access to $396,000. Let's see, $296,000. Some folks would just take it and spend it all, and they blame it on the reverse mortgage
When it's all
gone. And so we build a safeguard into it. Only 60% of that $296,000 is available the first year. So in this particular example, they're going to have $167,200 the first year, and then 1 year and 1 day later, they'll get the balance. And that balance has sat in that account and it has appreciated.
And that is just access to the balance. It's not that the money is sent to them. It's just sitting there waiting if they need it. And while all this is going on, if they've taken out this home equity conversion mortgage with you, they're not making a house payment.
That is right.
Okay, so where does the money come due? And how does that look? At some point, this doesn't go on forever, but you did say that, let's say it's a couple and one person passes, let's say the older, and the younger one is still there. What happens, or what if it's tied to the younger one and the younger one passes and the older one is still there?
So it's always tied to the youngest one because theoretically they're going to live longer.
Okay.
And
but
so
if they die,
as long as one of the two individuals is in the home,
whose name is on the mortgage,
okay, then the line of credit growth will continue and they can stay in the home until they pass away. And once they pass away, their heirs will have up to 1 year to either sell the home or refinance it.
Okay, and pay off the monies owed, which is the money that was borrowed plus the interest rate that's been accruing on the money borrowed?
On the money borrowed. In this particular instance, one thing I need to, I will digress and talk for a moment. So we talk about this appreciation on that line of credit. So that is there's a mortgage insurance premium paid in the beginning to start this.
Okay.
And that's based on 2% of the value of the home.
Okay.
And that's what guarantees that line of credit growth. Okay. And that's why regardless of what happens to the value of the home, that line of credit continues to grow. Some folks call that a put, that it's, I'm going to go ahead and set this up. I don't need the money, but I want to leave it there. So when I do need it, when's the best time to buy insurance? When you don't need it.
When you don't
so
need it.
Individuals, the sooner you get into this at the age of 62, and the better your growth. In this particular example, the closing costs were roughly about $26,000.
Okay.
And that part of that is 2% of the value of the home. And that is,
Now,
and that's where the investors, they're making their money on this loan balance. So whatever growth there is on that loan balance, that's then when a maturity event occurs, the home is sold or both pass away, that's then when the investors will get a return on their investment.
is it possible to, as the person who's taken out this home equity conversion loan, to know what that balance is at any given time? Can you? Okay.
Yes.
But
We can set up an electronic account, and you can go in and check it at any time.
And I don't mean just the money sitting in the account that you have access to, but also what's owed on the property. So like if you've been living in this home, you stay in this home, and suddenly you can't stay in this home anymore, you need to go into assisted care or whatever. Can you then look at it to try and help you decide what your next move might be if you're going to sell before you pass away?
Absolutely.
Okay.
There was you get a what do we call it? A mortgage statement every month.
Okay, great.
I'd like to take a moment and give our audience a chance to look at this perhaps visually, might help them understand. So I'm going to share some slides here. Just a moment. Let's get us over here. All right. The big idea here is that most homeowners have wealth in their home, but it's trapped. It's not liquid. You can't just pull out the money. Why wouldn't I take out a home equity loan?
Well, you certainly could. The advantage in the home equity conversion mortgage line of credit is you do not have a required payment on the principal and interest. And this insurance program guarantees that regardless of what happens in the economy, that it cannot be canceled, that growth is going to continue regardless of what's going on in the economy.
That's huge right now.
So homeowners have a significant equity in their home. They don't know how to use it without selling or taking on more debt, like a home equity line of credit or a home equity mortgage. The equity they have isn't liquid. They can't just pull cash out. So what we're showing you today here is how to access that home equity without going into debt, how to eliminate the mortgage payments, create a cash flow, and how to create more financial flexibility.
And so can you go back to that one slide I just wanted to make? So the accessing equity without debt, without required repayment, but anytime they're accessing the equity, they are incurring debt.
Okay. Thank you for clarifying. All right. The home equity conversion mortgage, or HECM, convert the equity into cash, eliminate your mortgage payments. Please pay your taxes, insurance, and keep your home maintained. We've talked about that very many times. Okay, here's how conventional mortgage works. You're looking out there, there's a home out there, you buy it, you get a mortgage. It's usually a 30-year mortgage. And then you start making monthly payments. And that payment is going into paying off that loan month after month after month. Same thing, 30 years. All right. The home becomes more valuable and you're paying down the debt on your mortgage. So until one day, magically, this is not everybody, but ta-da, you have paid off your home, you have no home mortgage, and your home has increased in tremendous value over the 30 years or so of the mortgage. That's how the standard one was. You've got this home, it's very valuable, but it's not liquid that you can pull cash from. Okay, so let's look at a reverse, or the HECM. You've got your home, it's very valuable, you've paid it off or come close, very long mortgage. You should congratulate you if you do. It's a fantastic achievement. You've got this value in this home, but it doesn't bring you any cash flow. You can get cash by doing a home equity loan, but you're again paying debt. All right, so we don't want to pay debt. Let's get a home reverse, the HECM, the reverse mortgage. Suddenly the piggy bank is open and you can bring money that you have put into your home for decades, take off the mortgage payment, get a line of credit, increase your cash flow. So that can be taken as a lump sum. Some people do a monthly payment. So you could actually, if I'm correct, you could get a monthly payment from this mortgage. Is that correct?
Absolutely.
It increases the balance on your mortgage, right? Your reverse mortgage, but you could do that. Or you get a line of credit or some kind of combination of thereof. All right.
It's got a lot more flexibility than I was aware of. That line of credit, that's just amazing.
So who's eligible? You have to be 62 plus, and you have to have significant equity in the home. What percentage of equity do you need?
Well, it's always going to depend on the interest rates. Once upon a time, 4 years ago, interest rates were low enough that you'd only have to have 50% equity. Now you have to, depending on the age, if you're starting at 62, you're going to have about 70% equity in order for this to work. If you're 70 or 80, the older you are, the lower percentage of equity that you need to have in the home. Okay.
Why is that? I don't understand that.
They use actuary tables. So theoretically, that 80-year-old is going to live for a shorter period of time. And so there's more access for
Okay.
them versus, and then of course, they're not going to run out of this equity. Now it isn't all of the equity that's in the home. It's just the percentage of equity that's going to be made available through this home equity conversion mortgage.
Okay. So if you paid off your home and it's worth $1 million, you're not getting a check for $1 million.
Correct.
No. And the other thing, the old reverse mortgages, they didn't have that line of credit part of it, did they?
They actually did.
Did they? I was not aware of that. Okay.
This mortgage, how do you access the funds that you have built for decades that are invested in your home but aren't liquid? So you contact a mortgage broker that's certified in the HECM.
Like
Admiral. Okay. You have to supply the necessary documents. You got to prove your insurance. You got to prove you paid your taxes and that you have been paying your mortgage in the past. You have the house that is appraised, and then you have to attend the education class.
Yes. And that education class actually will come before the home is appraised.
Now, is there a fee for the education class for homeowners? Okay.
Yes. The average cost is about $175.
Person, or do both people, I would assume?
Yes, for both people. And, the kids can be there. And it's our obligation to make sure that the client understands how it works. And so these individuals hired by the Housing and Urban Development team, we can't, as loan officers, we can't have any contact with them. We can't be on the call with the client. We shouldn't be at their home. They want to make sure, this is part of the protection, be sure that they know what they're getting into. And these counselors also have been trained to understand that sometimes one of the kids or grandkids has a gun to that parent's head to get them because they want their money now instead of waiting. So they ask questions specifically to kind of determine if there's what do we call it, elder abuse going on.
So do the counselors then have a say in this whole thing if they feel it's not a very good, like if they find that sort of thing going on, they're not going to tell you to go ahead and issue this money? Is that
they won't give us a certificate, so everything stops right there. Okay. So that certificate has to be signed, and then we can then proceed to the next step.
And then the appraisal happens. So we have that a little bit backwards.
Right. So is it safe?
Yes. This is insured by the FHA.
Not the FDIC. FHA. All right.
So, and you can't be removed from your home as long as you make your property taxes and insurance payments. And of course, if you're in a condominium and there's HOA dues, that's
another one. Yeah. They must, you have to pay them because they can foreclose also. And the mortgage class, do they have to go somewhere for that? Is it a Zoom meeting? Does someone come to them? Is it a telephone call? How do they do it?
They can visit, but the easiest thing is a phone call.
And do you, as the lender, help set that up for them?
I cannot. I can only, well, yes, actually, part of the initial documents are a couple pages that show the 9 federal agencies all over the country. And then it shows 5 that are within that district or region that the person was in.
So if someone is interested, they can reach out to you and you can direct them to where they need to go to start the process. This is not something that as realtors we are involved in necessarily, unless, and there is an unless, you can actually buy a home on a reverse mortgage, can you not?
Yes. And that's one of the things one of the biggest secrets. There's so many, with all due respect, but most consumers and most realtors, unlike yourselves, do not understand that there's a home equity conversion mortgage for purchase. So a person can actually purchase a home using the home equity conversion mortgage. We call it the H for T.
So they would have to do a down payment.
Yes.
Of so if they sell their home, make the down payment, which is it vary depending on age and the whole thing?
Yes.
I'm getting it.
if we use that same $1 million example, and we use that same 62-year-old, that 62-year-old will have to come up with $700,000, and then we're going to cover the $300,000.
Okay.
And that $300,000. So for you as realtors, one of the greatest things is there's many people right now that want to upgrade. They want a more modern home, but they don't want mortgage.
Or maybe they want a beachfront home, or maybe they want a lakefront home, or maybe they want a cabin, but they still want it to be really nice. And prices have gone up. So if their home, when they sell it, can provide them with enough equity to do the down payment required, then that loan comes into play to finish it off so they can buy more property and they don't have a payment on that loan. Do they still have a line of credit on that loan or no?
Only if they decide they want to make a payment. So whatever payments they make go into that line of credit immediately.
And then it sits there and it appreciates based on the interest rate of the Treasury note, which right now is like 6. I'm getting it.
Yeah. Yes.
So you're saying that somebody who has a significant amount of equity with this reverse mortgage could not just downsize to a smaller home, which we typically think of. They can actually upgrade to a more expensive home and a dream location across the country. Maybe kids live in California. It's more expensive there, that they could actually do an upgrade.
Yes. Yes. And then they could theoretically, they sell they buy it. Let's say their home was $1 million, but it was a 2-story and they wanted a Rambler. They could right size, get another $1 million home, have sell their home for $1 million, and then have $300,000 fees that they've taken out of that illiquid asset and can maybe give their kids a down payment for their next home, or travel, buy a second home.
Can you use this on a second home?
You can use that line of credit on a second home, but it's required that you must live the home that the HECM is done on. That must be primary residence.
Okay.
That you must technically live in for 6 months and 1 day per year.
Okay. Is there anything else you think that our listeners should know about this?
Are there any downsides?
The downsides. So we're talking about the refinancing. If a person is only going to be in their home for 3 years, then I don't know if it's the best idea, simply because of the upfront costs and so forth. So we always ask, is this going to be your forever home? Is this just a home you want to age in place in? And so I'm not saying that we won't do it, but our company we're going to advise against it. We're going to say, you're right. This is a good way to go, but let's wait until you're ready to 3 years from now when you're going to get into another home, because you're going to increase your equity that you're building up. And then you can use the HECM to purchase that next home. And one thing we didn't talk about, but I hope you don't mind me talking about it right now, is that, the Holy Grail used to be a paid off home.
Mm-hmm.
And to some extent it still is, but our research has shown that the reason we want a paid off home in retirement is so we don't have any mortgage payment.
Correct.
But I've had clients that I've helped who they retired early from a job they didn't particularly like, because they then did not have a required mortgage payment. And that just I've had clients say that they've gone from what they call us curmudgeons to this happened to Grandpa? Why is he all of a sudden so happy? Well, he's so happy is because he no longer has that to work that job he doesn't like. He doesn't have to work for another 4 or 5 years. And I've had folks, they didn't retire because psychologically they knew that they could say they could retire the next day.
So the weight of having to work was lifted.
Oh gosh, this kind of breaks me up. I have a friend of mine, and he came to me and he says, Susie and we just remodeled our kitchen and our family room, and we just love it. But excuse but these are his words. I'm afraid my fat ass is going to stroke out, and I want to be sure that Susie gets to stay in the house. And I said, well, let's go over more deep. He says, no, you know me. You know, I've read everything. This works for us. And it just fills me with joy. We went to lunch, and then when we drove back I picked him up, and we drove back to his house. And I said, Joe, and he says, what? I says, your home looks different now, doesn't it? And he says, you're right. It feels so good to know that we can stay here for the rest of our lives.
Yes.
And that is the thing. That's why I do what I do, that seniors like myself can have the best retirement, and us curmudgeons better husbands, better grandparents, and better friends.
And that's why we like Admiral so much, because that falls right into our belief system on working with people to make their lives better. I really appreciate you taking time with us today, Admiral, and I hope that if anybody finds this, giving them a little hope for their future, regardless of what that looks like, that you will consider reaching out to Admiral and talking to him about this. Or you can always call us and we can connect you with them. And if you're thinking of buying or selling, well, and then instigating that reverse mortgage, of course, please feel free to reach out to us. Right, Dennis?
Yeah, here's Admiral's information. Works for Fairway Home Mortgages. Give you a call if there's something that's interesting. If you want to see how this works with the home equity conversion mortgage, works with selling your house, purchasing somewhere, a home in some other location, downsizing, we're the ones to turn to for that. But Admiral is the one to go to for the mortgage advice, because he is the certified HECM mortgage broker. You have to have specific training on this mortgage?
With our company, yes.
Yeah.
You have to, because it isn't just a mortgage.
No.
It's more than just a mortgage. And for us, first of all, we wanted to make sure it's a sustainable solution, but we just want folks to know what it is. There's no ever pressure on our side. What we like to do is show, here's another option to look at. Period. There's an option that most folks don't know anything about it. And I have to tell you, at my advanced age, that's why I do what I do, because it's just, when somebody says, that sounds too good to be true. And that's actually what I said when my buddy introduced it to me 6 years ago. I didn't even want to hear it, but I had known it for so many.
That's been the case. People are like, oh no, that's a horrible loan. I've heard horror stories about it. Well, maybe it used to be, but it isn't anymore. It isn't anymore.
Thanks, Admiral. This has been Getting Your Edge, How to Downsize Your Home. Our podcast has many episodes about all kinds of topics to deal with downsizing. And we hope you subscribe, like, share to build our audience. And so we can provide more and more of this informative, commercial-free.
Yeah.
Thanks so much.
Thank you.
Thank you, everybody.